Paul here, Smart Financial, back from Alaska. Middle class is going to really like this tax bill. Okay, I did a couple of videos about this new tax bill. It's July 2025. I think rather than try to take a 900-page bill, right, and do a long, droning YouTube, we're doing it the way I did my 3 books, in little bites. And as you know, if you follow us, and if you don't follow us, go ahead and subscribe. You can go ahead and reach out to us with questions. If you want a free copy of either Smart Grandparenting for Boomers, or Longevity for the X-Gen, or Wealth Building for the Millennials, just reach out. There's 3 books. We're happy to distribute them to people, and it's just personal financial information. So we're going to talk about how this tax bill affects you if you're middle class. I did one on the affluent, and I'm doing one on folks with lower income, but this is strictly a middle class tax bill, in my opinion. It's got some good things in there for the middle class, and I think the key here is I want you to remember that I'm very pro advisors, and I know that a lot of folks get their financial information online and through ChatGPT and all that stuff, but I would like you to reach out and do these 3 things for me. Please, call your accountant, your tax preparer, your enrolled agent, whatever, who's got, the records of your tax return in their files, and say, how is this going to affect me and my family? Because of 2 things. Number 1, I don't want you to do something that's a mistake or miss something that's an opportunity, okay? Call your wealth manager, call your investment advisor, ask them about this tax bill, how it's going to affect you. There are some opportunities here. I actually think there's some very significant Roth conversion opportunities coming up, okay? And then I would like you to, if you happen to be in that middle class category that's about to retire, I think you really need to reach out and talk to your insurance professional, your insurance broker. We're happy to be sponsored by Legacy Insurance Brokers. You can see them in the links that we have. Talk to someone about what your retirement insurance needs are going to be after this bill, and that includes Medicare, Medicare supplements, Medicare advantages, life insurance, all that sort of stuff, okay? So please make those 3 calls. Take care of yourself a little bit by listening to this, but reach out to others to help take care of your finances. Your CPA, your wealth manager, and your insurance person. Okay, let's get to it. So if you happen to be in the middle class category, you're a family of 4, 2 working people, you make about $150,000, right? You're gonna get the best out of this bill. What you need to know is certain things over $150,000 of income phase out. The definition of phase out means that tax deductions disappear the higher you get in income, okay? But under $150,000, you're kind of golden, actually. And this applies to those 2 big things that are advertised like crazy. If you have some income from overtime and some income from tips income, these are important because you're going to get a little bit of a tax break out of those. It's not monumental. The Tax Foundation has come up with a number that if you are around $96,000 of taxable income, you're going to save about 1.8%. That's $1,430 a year. So it's about $100 and something a month. Okay? It's not monumental, but it's pretty good. And that on top of some of the other things could be good for you. You will be able to actually take the interest on loans to buy a car that is made in the United States. Now, there's a lot of slots you have to fall into here. It has to be a U.S. made car, Ford, Chevy, whatever, Cadillac, right? Made in the USA, and you can only take a tax deduction on the interest for the next 3 years, 2026 to 2028, 26, 27, 28. Okay. It's one of those things that disappears. A lot of the middle class tax breaks do disappear, but guess what? You can take advantage of it in 26, 7, and 8. That's not a bad thing. At least it's something that you didn't have before, okay? But don't go out and take a loan just for that, and don't take a 10-year loan and only get 3 years of breaks. That doesn't make any sense, okay? You might want to look, if you're getting a car, putting down more money, and just having a 3-year loan makes good economic sense. Okay, this applies to about 8% of the population, by the way. According to the Tax Foundation, there's about 8% of the American population that has either overtime or tip income. And so for them, this is a little bit of a break. All right. Now, the next thing is you will actually be able to itemize in many cases, although they have upped the amount of exemption, so some folks won't have to itemize. And let me read the number to you exactly because I have it here in front of me. If you're a family, you file jointly, the standard deduction that for non-itemizers is going from $30,000 to $31,500. So that's $1,500 more that comes off your income before you start paying taxes. So number one, If you don't itemize, you'll have a 31.5. If you do itemize, there are going to be more things you can put into your itemizations, like that interest on your car. Okay, so this is why I want you to talk to your accountant. You might actually be flipping from a non-itemizer to an itemizer. And for a middle-class person that can save a few $1,000s on that and the child care tax credit, that's a real thing. So if you've got, kids in your house, and I have to read this one too, that you get the auto loan deduction, you get the child care tax credit, a one-time $1,000 credit to account for child care expenses between, again, 2025 right now and 28. So I wouldn't rush out to have a baby just to get that $1,000. Babies have a lot of other great things, but it's just an extra $1,000 tax credit that can actually be meaningful. Now, there are more reasons to actually pay for a tax preparer. So if you've been doing self-prepared taxes, there is sort of a hidden cost in here that I want to point out. I do think if you were going to ever pay somebody to help you with your tax return, it's going to be 2025. I'm fond of saying that I started in the financial industry in 1974, and until I sold out of our practice 50 years later, there was 47 tax changes in 50 years. But actually, now I have to say 48, because now we're doing financial education, and guess what? There's another tax change. And I love CPAs and wealth managers and financial advisors. My world has been full of them, and 97.9% of them are wonderful people, and the world is full of 2% jerks. We know that. But of the good people, right, if you call your CPA and say, can you just help advise me on whether I should, buy a car now or something else, they're not even going to bill you. I think some higher end CPA firms, yes, you will get a bill, and I'm not trying to generate fees for them, but I do think that if you're a higher end person, especially an affluent person, you've already got a CPA and a wealth manager, they should be able to help you with this question. Now, I will give you Linda's example in mind. So we have been planning for a number of years to do some remodeling at our home in the state of Colorado, and we were putting in, you have a lot of sunshine there, putting in like a new roof and then solar and a solar wall and a charger and get some EV truck. Well, guess what? That's off the table. And the reason is, I will confess to you that I guess we waited too long. I didn't have a crystal ball. I didn't know they were going to take away these deductions, for EV and for, solar incentives. It makes no sense for Linda and I to do it now. That's the kind of thing that I want you to apply to yourself personally. For instance, if you are going to buy a car, and you're going to buy, as my daughter did, a Toyota, or my niece did a Toyota. Remember, those don't get any incentives, right? It's only American-made cars. So these are decisions that I think that you need to pay attention to. Overall, I think if you're a middle-class person, you're going to like this tax bill for 2026 to 2028. There's a couple of quirky things in it. I think if you've got kids and you've got a 529 plan and you're saving for them, that's a very good thing to do for college. There's a new $1,000 tax credit for putting money away for your children. I think that's okay. It's kind of, chicken feed, so to speak. But I do think that, hey, $1,000 is $1,000. So I think if you're a middle-class family and you're workers and you've got overtime in your income, you've got tips in your income, I do think you'll spend a little bit more on tax preparing, okay? I do think that there are some parts of this tax bill that are going to expire in 2028 and they're going to go away, so I want you to take advantage of them. But, this is not a political comment. It's just that tax bills change every time there's a new administration. And guess what? This administration will be over by then, so I think they don't really care what happens after 2028. So let's go forward with things we can do now, right? And paying attention to tax breaks that you can take while they're available before they expire. That's just part of the art of being smart.